Hello everyone, my name is Marc Werkmeister and welcome to another PFA update. We're going to be talking about markets and household net worth, and with the Dow Jones hitting 40,000, I thought it would be a good time to dig a little deeper and see how not only the markets are doing but how consumers are doing. The first slide we're going to go over here looks at household net worth. So in general, when markets are doing better, when people have more money, when balance sheets are better, they typically spend more. And even though this year the markets have done better, it's a little bit different because a lot of people are under the impression that the markets have done poorly. There's been such a wild swing in the market since January 1st, both up and down. We had a really bad April, then we rebounded really quick in May. But the fact is we're at all-time highs. So this chart is showing us that financial assets have continued to creep up. After COVID, they took a dip, but they've continued to creep up. And non-financial assets, which for most people, their biggest non-financial asset is their home, homes have continued to rise as well. So once again, the Dow Jones hits 40,000. Consumer balance sheets actually look stronger. Higher stock market values, higher home values. However, on the flip side, when you dig into it, you start to see the negative, and that is the consumer debt. So consumer debt has also begun to grow. So even though financial assets and non-financial assets are up, so is debt. And they refer to it as the wealth effect. So when your accounts are higher, when your homes are worth more, when you're getting raises at work, you typically spend more. And it's more of a psychological thing than actually a numbers crunching budget issue, as people just feel better about things, so they spend more, and that's been the case. So we've seen credit card debt climb all the way up to 1.1 trillion. But the big alarm is that 9% of accounts right now are delinquent. On average, it's only about 6%, so we've seen that climb up over the years. We've also seen auto loans, balloon up to 1.6 trillion. Some of that is inflation on the cars themselves, but once again, some of it is just due to people spending a little bit more. And with higher interest rates, more debt, we see bigger monthly payments, which leads to a little bit bigger squeeze on people's monthly budgets. Which leads us all to consumer sentiment. Consumer sentiment is one of the strongest indicators of how the markets, long-term markets, are going to do. And like I said, when people feel better, they spend more. Corporations make more money. Corporations are what we invest in, so the stock market is made up of those corporations. And so right now it has been, it started to bounce back after the COVID lows, and it's been seeing a little bit of a decrease here lately. But if you really look at the underlying factors, unemployment's low, wage growth has started to get a little bit better. The big thing out there causing lower consumer sentiment is inflation. And so if inflation continue to either stagnate or come down, things actually look pretty well on the consumer sentiment. So I think big picture, it's important to focus on some of these issues and some of these long-term trends instead of the day-to-day headlines. I mean, already this year we've seen all kinds of different news break that are causing these large swings, which is pretty typical in an election year. But if you look at the larger picture, it helps get a better idea of how your investments are doing and what the future may hold. Thank you for joining us, and we'll see you next time.